Welcome to Climate Risk Asia Week. I'm Jason Linsunis, Senior Editor with the Economist Intelligence Unit for Thought Leadership in Asia. So here we are online for Climate Risk Asia Week, and this was originally scheduled to take place in person in Singapore. But the global pandemic that's making itself even more widely felt, even as vaccines are announced, put the brakes on that, and we are now gathering virtually for what we hope will be an interesting, educational, and productive week that has brought together key policymakers, business leaders, academics, and the media from Asia Pacific and beyond. Firstly, I'd like to thank our generous supporters for this event, McKinsey & Company, Adani Renewables, Mitsubishi Heavy Industries Group, TrueCast, part of S&P Global, and Standard Chartered. Secondly, I'd like to encourage you to explore the event platform. We have a huge amount of content available to you, featured at the exhibition booth and alongside these sessions. The platform also enables you to connect with your peers from across the region, and I strongly suggest you do so. Please also take time to repeat or take in sessions that you may have missed at 5:30 p.m. each day. We will make all sessions available for rewatching on demand. Now, to open the week, I'm delighted to be joined by four esteemed panelists. Norshan Shia from Bank Negara, Malaysia. Huisin Lee, Chair of Intergovernmental Panel on Climate Change. Satoshi Akita, Chief Sustainable Finance Officer at Financial Services Agency, Japan. Ho-Hearn Shin, Assistant Managing Director for Banking and Insurance from the Monetary Authority of Singapore. You can find all these full biographies for each panelist on the screen under this media player. So this panel will set out the main areas of climate risk, and we will discuss how business leaders, policymakers, and regulators are responding to the challenges they face. So to start that off, we're just going to really get into the big picture and start out with what does climate risk mean to you? And if we could start with Ho-Hearn Shin, that would be great.
Thank you, Jason. Well, climate change is the existential challenge of our lifetimes. The Earth is warming up at an unprecedented rate. Our polar ice caps are melting, sea levels are rising, extreme weather patterns manifesting far more frequently than we would have expected, several decades ago. And this has taken a heavy toll on human life, as well as costs financially, into individuals, businesses, societies, their financiers, their insurers. As a financial sector regulator, we're keenly watching this space and very aware of how these risks can impact the safety and soundness of individual institutions over time, and impact their balance sheets, as asset values may get written down in the meantime in the transition to a low carbon economy. But at the same time, we are also keenly aware of the opportunity and the privilege of the financial sector being a conduit for channeling important resources, that they can really make a huge difference in this effort as we transition to a low carbon economy. And so we're also looking for opportunities, working very hard across the aisle with financial institutions, NGOs, to see how we can challenge as well as motivate and in some cases mandate the financial sector's support for this very, very important shift. Thank you.
And Mr. Akita, same question to you.
Thank you, Jason, for that question. Well, my answer is very practical. Well, I'm from the financial supervisors community. And so while climate risk is ultimately the potential losses that financial sector could incur on their balance sheets and due to climate change, and the consequential threat to the financial stability. While the financial supervisor communities without seeing the climate change issues from the perspective of financial stability, it has triggered certain thought change among the financial supervisors and central banks who oversees the banking sector and the insurance sector globally. And so while climate risk is a bigger risk to the financial stability, that's my answer.
Thank you. And Ms. Noor Shamshir, can you tell us about what climate risk means to you?
Thank you, Jason. Historically, Malaysia has been rather fortunate to be able to enjoy a temperate equatorial climate, minus the vagaries of wild weather phenomenon, such as sharp fluctuations in annual temperature, seasonal typhoon, and devastating floods. Our strategic location in the center of ASEAN has also always attracted traders from different parts of the world. And this has allowed the old Malaya and later Malaysia to prosper and develop into a modern economy, making it the 42nd largest economy in the world. However, climate risk has significantly changed all that across Asia, especially in the Southeast Asia region. Physical risk has received closer attention from governments and central banks alike. So Malaysia is no different. So while the country has a diversified economic base led by services and external sectors, close to 10% of our economy is made up of agriculture and resource-based manufacturing sectors. As a result, any significant climate event can have large implications on certain parts of the economy. In 2018, for example, our agriculture sector contracted by 0.4% following the onset of a severe drought. And the rebuilding cost post a major climate event is also costly. In 2015, our government spent more than $560 million to rebuild certain areas that were affected by the worst monsoon season, flooding in 3 decades. So going forward, the risk from climate change in the form of severe floods, rising sea levels, and heat wave to Malaysia will likely increase further. And based on some estimate, by 2015, the average surface temperature in Malaysia is expected to increase by 1 to 1.7 degrees Celsius. And the sea level is also anticipated to rise, potentially inundating several state capitals and resulting in significant losses in property and arable land. So in terms of economic development, the climate risk present an opportunity for us to pivot our economy towards our commitments in the Paris Accord and the UN Sustainable Development Goals. So climate change will pose a significant challenge to our agricultural sector, for example, such as large and smallholders rubber and plum plantation. Already some of them have begun to monitor and reduce their carbon emissions throughout their operations. And beyond monitoring and reducing greenhouse gas emissions, so there will also be pressure on these planters, large and small, to modernize, innovate, and mechanize in order to remain climate resilient and become sustainable producers. I'll stop here, Jason.
Thank you. So, Dr. Lee, we talked a little bit about this in your keynote address, but maybe you can recap a bit. What does climate risk mean for you?
Thank you, Jason, for the question. And the risks depends upon really where you live and what you do. And for instance, if you live in an agriculture-dependent countries, the climate risk means you would expect a reduced crop yields. For instance, if you live in the southern hemisphere subtropic areas, and we have observed the 1 degree warming, 1 degree warming lead to the reductions of economic growth there. And if you live in the coastal areas, then you feel the impact of the ocean warming, also the impact of the ocean, reduced ocean, increased ocean acidification, and obviously it will lead to the reduced fishery catch. And overall, whether you live, regardless of where you live, you would expect the extreme weather, heat waves, and floods, cyclones. Its frequency and severity will aggravate due to increasing climate change. And in the end, we should all expect water shortage, food security problems, and health issues rising very rapidly with this continuous trend of greenhouse gas emissions and resulting warming.
So that brings me to drill down to a little more detail. And Mr. Kida, maybe we can start with you. Which climate change risks do you see attracting the greatest attention today from investors and maybe even by organizations like yours?
Well, I think in terms of the transition risks, that the energy transition and the mobility transition are the top 2 risks that are attracting the investors' attention right now. In terms of physical risk, which the other panelists elaborated so far, well, certainly the occurrence of a catastrophic natural disaster like hurricane, typhoon, cyclones, also the wildfire, I think is the focus of the investors right now. And well, from the perspective of a financial supervisor like Financial Services Leadership Japan, well, I think the main focus of attention is not so much different or broadly similar with investors. But I think the time horizon that financial supervisors have and the time horizon that investors have are a bit different. I think the financial supervisors take a longer time horizon in decision making, while some section of the investors are more short-sighted. And so, really depending on the investor types, the long-term oriented investors, I think the focus of attention is mainly aligned with the financial supervisors one, and which is, I think, very encouraging.
So, Ms. Sin, from the monetary authority's perspective, is there an area that, as far as climate risk goes, that do you see that's creating that's drawing greater attention from investors? Is that something that you have a perspective on?
Yeah, I'm not sure that it's actually a climate risk area that investors are particularly focused on. Although I would say that in the ASEAN region and Asia region, one big opportunity is actually in financing alternative energy sources. And there's a report that has said that in the Asia Pacific region, we could attract investments of up to 1.5 trillion through to 2030. That's just over the next decade. And that's on wind and solar. That's on the non-fossil fuel type of energy. And wind and solar would account for maybe up to 60 to 70% of that. So that's obviously an area of big interest. But I think as financial sector supervisors, what we're really keen on is to see the financiers in the economy, whether asset managers or bankers or even insurers as investors, to really not ignore that transition risk. And I think there has been reports saying that the impact of physical risk has not been properly priced into asset prices, equity asset prices yet. And that's something that we see greater awareness in the recent, months and years, where investors are making a more focused effort to try to quantify this and to account for this in their investment portfolios, so they do not become the subject of sudden write-downs in asset values.
So following on that idea of pricing and risk, how important is the role of the financial sector in managing that risk? Ms. Norsham Sheikh, could you talk to us about that a bit from your perspective?
The role of the financial sector is important. And in this journey, we recognize the need to collaborate with many stakeholders. This is a very complex issue, and no one institution, a country, or region can claim to know all, nor can it do it alone. So there is so much to gain from working together. So what we have done domestically is to work together with our securities regulator, our stock exchange, and our financial industry on collaborative actions for building climate resilience within the Malaysian financial sector. We are also working with central banks in the East Asia through our ASEAN finance process, and also the Asia Pacific Central Banks, what we call the EMIAP Forum, to address the challenges posed by climate change and policies. So we are also a member of the NGFS, and these platforms provide opportunities for cooperation among regulators and sharing of best practices to better understand, manage, and respond to climate and environmental related risks. Within the region, ASEAN provides an established platform for coordination and collaboration. ASEAN Finance Cooperation has already delivered several joint initiatives to manage physical and transition risks rising from climate change. This include managing physical risks centered on improving disaster risk management through the ASEAN disaster risk financing and insurance. And this what we call the ADFRI, in short, is now focused on equipping ASEAN members with risk management and risk transfer capabilities to strengthen resilience against financial losses caused by natural disasters. And early efforts to manage transition risks have also focused on the development of standards to facilitate fundraising for green investments in ASEAN capital markets via the ASEAN Green Bond Standards. And this year alone, ASEAN has achieved several milestones with the completion of guiding documents and roadmaps on the way forward for the banking and capital market sector. For the banking sector especially, Bank Negara Malaysia has led a regional collaborative effort to further understand the implications of climate and environment-related risks on both monetary and financial stability, the roles and the limits of central banks, and put forward a set of non-binding recommendations. But more importantly, ASEAN finance ministers and central bank governors have made sustainable finance a permanent agenda at their annual meetings beginning from 2021, where the focus will be on implementing these recommendations. Thank you, Jason.
Thank you. Dr. Lee, tell us a little bit about your perspective on the role of the financial sector in managing these risks.
Achieving the net zero carbon emissions by 2050 requires an additional investment amounting to about 0.36% of global GDP throughout this century. And Very interestingly, this investment, most of this mitigation and adaptation investment have a characteristics of its front-end cost is much larger than the life cycle cost, and therefore financing needs is tremendous and will continue to increase. And unfortunately, the many levels of decision makers under this so-called short-termism. And I think there should be various ways to overcome this short-termism. And I believe the financial sector is the one who must be spearheading this de-risking any attending barriers for barriers against the investment toward net zero by 2050.
Thank you. So, Ms. Sin, the Monetary Authority recently completed its consultation on proposed guidelines on environmental risk management for banks, particularly insurers and asset managers. Can you tell us a little more about how that works? Will the guidelines on climate disclosure become mandatory regulations, and when do you expect them to come into force, and what does that mean for the financial sector?
Thanks for the question, Jason. So maybe if I can just set some broad context first. We are keenly aware, as I said earlier, about the need for the financial sector to take a concerted action to play their important role in channeling private capital into that journey into a sustainable, low-carbon economy, and in helping institutions and companies make that transition as well. But it is really an area in which it's quite nascent. There are no rules yet in this place. And there's a lot of uncertainty for institutions. They don't know how to start, even if they wanted to start. And therefore, we thought as a supervisor, the least that we could do is to start with a very strong nudge through supervisory guidance to draw that bright line in the sand to tell financial institutions, hey, this is not a risk that you can ignore. And here are the areas to pay close attention to. We adopted a very collaborative approach, being aware that we are, not the expert in this area either. And we partnered with financial institutions, industry bodies, as well as NGOs to put together a set of guidance. And this guidance will be issued very soon, before the end of the year. And it will apply to banks, insurers, asset managers. And we will broadly cover environmental risk management in three broad areas. The first one is on governance. And the thinking there really is that board and senior management must exercise strong oversight on environment risk management within financial institutions. And this includes approving and implementing risk appetite statements, ensuring that they have robust risk management frameworks and policies, that adequate resources and capabilities are actually put to bear in this very important work. And the second area would be on risk management. We've set out in our guidance for financial institutions to be able to assess, to measure, to monitor, and to mitigate their environmental related risks. And they should adopt sound methodologies and tools to be able to assess these material risks. And this will include scenario planning, stress testing capabilities, which I must say is still quite nascent at this moment, but that's really an important capability to build over time. And in the sectors that pose higher environmental risk, financial institutions will have to develop specific mitigation policies, as well as support customers and investee companies to make that transition to make decisions to move from a high carbon into a lower carbon set of business practices and towards sustainable medium to long-term business practices. And then the third area is, you had alluded to that as well, on disclosure. We would want financial institutions to make meaningful, usable disclosures to the public, not just on their approach to managing environmental risk, but also to be able to quantify and explain what is the impact on their financial performance arising from material environmental risks. So they should, I suppose, reference internationally recognized standards like the TCFD, but we've not sort of, mandated specific ones. And in that journey, I suppose currently it is still a set of guidance, meaning that it's not mandatory. And with, at the moment, not yet mandated for financial institutions to make these disclosures, because we realize that we're still quite early in the journey. And financial institutions haven't yet got the full implement of capabilities to properly measure their own financial footprint, especially those of their customers and throughout the entire supply chain. And mandating disclosures at this stage, I think, may result in rather flimsy and poor quality disclosures. So as the first step, our focus is really in working with institutions to better understand financial risk, build capabilities, build abilities to quantify this well before over time we can think as a subsequent step whether to mandate it. So following the issuance of this guidance later this year, which is very soon, we will be working with financial institutions on their implementation efforts. Thank you.
Thank you. Disclosure does seem to be a topic that comes up a lot in the research that I do with ESG and the asset owners, but that's definitely an issue. And Ms. Noor Shamshia, I think you also recently made an announcement with Bank Negara that they're soon going to finalize climate change principles-based taxonomy to help align that understanding and assessment of risk. Can you tell us a bit more about that?
Well, the principle-based taxonomy, Jason, is one of the building blocks of Bank Negara Malaysia's effort to accelerate the transition towards a low carbon and climate resilient economy. The taxonomy outlines 5 guiding principles for the assessment of economic activities. And these are, number 1, to support climate change mitigation. The second principle talks about the need to support climate change adaptation. Third is the principle about do no significant harm. The fourth is about supporting remedial efforts. And the fifth and last principle is on not to be involved in illegal or prohibited activities. So these guiding principles recognize the importance to adequately manage climate-related risks and support green transition while taking into account the state of economic developments in Malaysia and the nascent stage of climate risk management at which businesses are currently in. So in contrast to other taxonomies, practices to strengthen commitment and willingness to improve are taken into account in classifying economic activities. So based on these 5 guiding principles, economic activities can be classified into 6 categories. So category 1 is the standard that businesses should aspire to achieve, whereby their economic activities will support climate change mitigation, adaptation, and do not pose significant harm to the wider ecosystem. So financial institutions are encouraged to play a nurturing role and promote the transition to greener practices. So progress of the transition to greener and more sustainable practices can be measured against several transition categories like C2, C3, C4, and so forth. So underpinned by the philosophy of financial inclusion and being cognizant of the strong need to meet the funding requirements of businesses, in particular the less sophisticated SMEs, the bank takes the view that the taxonomy must incentivize and encourage nurturing to facilitate smooth transition to a climate resilient and low carbon economy. So the principle-based taxonomy, coupled with the ability to track and appraise the transition of businesses, as opposed to a binary green-brown assessment, can assist financial institutions in influencing changes in the operations of businesses and support the transition. While the principle-based taxonomy provides a foundation for financial institutions to track green lending and investment, we are the view that the critical success factor hinges on the shift in both mindset and actions of businesses and their value change. So in order to achieve the critical mass, we recognize the need to devise more comprehensive action plans involving wider stakeholders. I'll stop here, Jason.
Thank you. So all this issues of regulation and taxonomies, that really kind of brings up the question of do countries need a sort of like watchdog type organization similar to, say, the anti-money laundering regulations, like, or the SEC Securities Exchange, things like that? You know, is a climate-related organization something that's needed? I want to get everybody's opinion on that, but let's start with Dr. Lee.
Governance is very important, and not only for climate change stabilization, but also for achieving the sustainable development. And our assessment clearly indicates that the information sharing is critical to all the stakeholders, especially, as you mentioned very often, about the climate risks, but as well as other risks attending to the global climate changes, related to the global climate changes. And in that sense, the close interaction between science and policy is very important. And that's where the IPCC contributes to this discourse of climate stabilization and achieving sustainable development. And I think that the goal of strengthening the financial, strengthening the mechanism of financial stability is very, very important in a sense that the world's aspiration to achieve net zero by 2050 depends a lot about the availability of financing, and that depends a lot about the health of financial sectors of the global economy.
So, Mr. Akita, from your perspective, do you think that there is room for an SEC type organization? Do countries need that? Or is that something that we can do voluntarily?
Thank you for that question. Well, I think the creating a new agency is not necessarily a solution, I would say. Well, from the reporting perspective, even within the current reporting framework, if climate risk is deemed material, it must be reported properly within that framework. And so what is more important is developing the coherent reporting standards on climate-related matters and making sure that such standards are well aligned with the current reporting standards operating under the principle of financial materiality. While incorporating climate-related matters into the existing reporting framework maybe one giant leap, but it is not that total secession from the current regime. Also, from the financial supervisor's perspective, incorporating the climate-related risk into the supervisory framework is a challenge. And I believe that the supervisors globally right now is working on that challenge. And the Network for Greening the Financial System, NGFS, is spearheading the work related with this. And they developed the certain guidelines for the supervisors, also the certain climate scenario analysis tools. And I think with those development on the front of the corporate reporting and on the front of supervising the financial institutions, I think put those together, I think the financial supervisors or capital market regulators are transforming themselves into the certain watchdog for overseeing the climate-related risks that would affect the financial stability or capital market. And I think what is important is make them well equipped with the capabilities and the tools to address those risks. And so, I think we are right now on a journey to achieve that. So, I think the solution is equipping the worldwide financial supervisor and capital market regulator with such capabilities and tools.
Thank you. So, Ms. Howard, this sort of circles back around to you. Do you see a need for a watchdog agency, or maybe that's part of your role for setting these rules in the first place?
So I agree with Dr. Lee that information sharing is going to be quite important in this journey. But I also agree with Ikeda-san that it has to be meaningful disclosure. And in order to do that, just mandating disclosure alone is not going to be the cure. We need common standards so that disclosures can be interpreted meaningfully to avoid issues like greenwashing. And financial institutions as well as corporates around the world do need to build up better awareness, better capability to measure what is their own climate impact in order to disclose this in a meaningful fashion. And as to whether it should be a new watchdog or through existing regulatory authorities or channels, I don't think that is the crucial issue. Because I think there are powers, to mandate some of these disclosures if we think that's the right step now. But I would emphasize the need for standardization, the need for capability building as a first step. Thank you.
So just to finish that out, Ms. Shamshila, is that the same sort of perspective you have? That we don't need a watchdog for this. We've got enough things in place already. Is that your perspective as well?
On this issue, for us, we have approached it, in a manner that is working together with the financial institutions and the other regulators. So we are not setting up another watchdog per se. We have set up what we call this joint committee on climate change together with the Securities Commission, our stock exchange. And again, another area that this JC3, what we call it in short, is working on is on governance and disclosure. And like what Jin has said, a priority in the next 12 months is for the members to work towards a wider adoption of the TCFD recommendations. So work is also currently being undertaken to develop a roadmap for this purpose, including a pilot implementation phase. We have conducted an initial assessment on climate-related disclosure practices. across a sample of financial institutions operating in Malaysia based on the TCFD recommendations. So what we learned from this assessment, we hope to be able to develop what we call this application guide on climate-related disclosure, which aims to improve the quality of disclosure. The assessment that we had conducted revealed that the existing sustainability governance structure does cover environment-related themes focusing on minimizing environmental impact, but not so much on climate change or on business resilience. We also found that Malaysian financial institutions have started to factor in climate-related risks and opportunities when formulating their strategies and policy frameworks that enhance business resilience, and have also started to explore climate-related metrics or indicators.
So let me just continue on with that thought a little bit, Ms. Noshanchia. How are you coordinating with other parties within Asia, like say Singapore or Japan, to help drive that kind of coordination and the response to climate risk that we need?
Like I said, collaboration is very key. So on the financial industry, we have set up this joint committee on climate change together with our securities regulators, our stock exchange and financial institutions. So that talks about the financial institution itself. But at the national level, we have also collaborated with the relevant ministries, because this is something that cannot be done, in isolation. So what we need is an overarching national policies that is driven by the highest political leadership. So this is something that we are also driving, and the government has also set up a high-level committee to drive sustainable policies and agenda, so that there is coherence, not just within the financial sector, but across all the other economic agents. And like what I said, not only do we need to work collaboratively domestically, but also collaboratively in the region. So, and that's where I had shared with you just now are some of the work that we have been doing at ASEAN level and at the EMEA level.
So Dr. Lee, from your perspective, do you see this type of coordination between countries happening enough? Are we going in the right direction there, or is there something more that needs to be done?
Well, we are not in a position of assessing the policy coordinations among our member governments, and we hope that, as some of my fellow panelists mentioned, use the IPCC assessment reports, which contain a very comprehensive risk assessment of this continuing global warming on various regions, as well as on various sectors. And we hope that this scientific information will be contributing to your decision making at every level of sectors, as well as issues related to your investment and other decisions.
Dr. Ikeda, Mr. Ikeda, for governments in APAC, does there need to be more done to support the growth of sustainable finance, either in any particular country or in Japan?
Sure. Well, as to the climate change issues, I think that the governments in the region should come up with a three-pronged climate finance strategy, I think. Well, in Japan, we often call it a TGIF strategy, a T for transition, G for green, I for innovation, and F for finance. Such strategic plan should include actions for green finance, financing activities widely deemed green. Also, the action for transition finance, that the financing activities transitioning to the carbon neutrality or net carbon zero, and actions for innovation finance, financing activities for innovation that are fundamental to realizing the decarbonized society, and balancing those three elements of the green, transition, and innovation is essential. And in endeavoring such strategy, I think the collaboration with science is very key. In terms of transition finance, so-called science-based target is a very fundamental foundation of accelerating transition finance. While science-based targets for science is very necessary in assessing the tenets of the transition finance. Also, the innovation, particularly in the area of the carbon dioxide removal technology. We need to be aware of the potential of the technologies and how we can commercialize those technologies in the long run. So we need a certain, very fundamental collaboration in realizing the net zero by 2050. And I think we tend to focus on existing technology like renewable energy. So greening the economy, we need to green finance. But I think often the transition finance and innovation finance are often neglected in that context. So I would like to emphasize that the governments in the region should take steps not only facilitating the green finance, but also the transition finance and innovation finance.
So we talk a lot about risk when we talk about climate, but like any crisis, there's always risk and opportunity. So maybe we can talk a little bit about what are the opportunities that go hand in hand with these risks? Are there is renewable energy investment, for example, the place that we see opportunity? Where else are there opportunities? Dr. Lee, can I start with you on that one?
Yes, thank you for the question. And it is very important that we always recognize the opportunity side of this climate challenge. And we expect that a great deal of opportunities will open up, specifically in the short term as a result of this climate-related the disclosure. It will lead to an opportunity for more climate-resilient investment. And let me tell you a few examples, like in terms of technology development innovation, there will be a tremendous opportunity for improving technologies related to decarbonization, as well as the methods of improving and enhancing the deployment of these new technologies around the world, especially from the developed countries to developing countries, which involves the tremendous effort of the enhanced international cooperation. And then in terms of infrastructure investment, we recognize that the infrastructure has a long lifetime. Therefore, it's very critical to have the infrastructure installed today that will have a lower carbon footprint throughout. This path dependency of infrastructure is a very important element in achieving the net zero by 2050. And we should not forget about the importance of the demand side of this equation. That is the consumption of the energy, and consumption of materials should be moderated. That can be possible through improvement in energy productivity, improvement in materials use, productivity of materials use. And all in all, the societal acceptance will be the key, whether we will be able to achieve the transition. That's another opportunity to improve, to manage the disruptions that we can expect from this rapid transition from this current BAU status to toward a net zero by 2050. There will be a lot of disparity in income distribution. Also, there will be a lot of disparity in the wealth distribution. Society will have to manage that in order to achieve the net zero by 2050. Particularly, there will be issues of stranded assets, and it's up to the society and your financial sectors how you intelligently manage and societally acceptable way of these stranded assets.
Thank you. So, Ms. Ho, what do you see as the opportunity?
So very similar in the area of financing alternative and sustainable sources of energy. Asia's energy needs are expected to double by 2040, and renewable energy sources are going to play a big role in that. And as you know, right now within Asia, we are significantly reliant on fossil fuels, whether for existing energy needs or planned energy needs. So there will be a lot of infrastructure financing opportunities, and Asia is well placed to capture that opportunity. And we are expected to be the leader in wind energy by 2050. The other area, I suppose, is in consumer demand and in changes in consumer preferences. So there was a survey conducted by the Alternative Investment Management Association and KPMG. It was a survey of 135 institutional investors, hedge funds, fund managers, and long-only managers, and they noted that 84% of managers reported an increased interest in ESG-oriented funds and strategies over the last 12 months. And there was then another survey of more than 1,000 investors in Hong Kong, Singapore, UAE, and UK earlier this year. This was by Standard Chartered Private Bank, and they found that 4 in 10 investors in Singapore are considering a 5 to 15% of reallocation of their funds to sustainable investments over the next 3 years. So these, whether it be on the sort of investment into key infrastructure projects or be it on the investor side, both on the supply and demand side, there's big movements in this area, and financial institutions can certainly have an opportunity to capture the benefits in this area.
So, Ms. Noor Shamsia, from your perspective in Malaysia, what are the opportunities that you're seeing related to climate?
Well, at the macro level, the government has also outlined this goal, like what Heng Chin has said just now, to increase the share of renewable energy to 20% of Malaysia's power mix by 2025. So that itself, within the renewable energy space, that also presents the opportunities to us. But in terms of products, we can see a lot of products also that can be generated to facilitate the institutionalization in terms of the funding, for example. There will be demand for funding in new ventures such as climate resilient agricultural practices and technology, sustainable forestry, watershed management, and climate resilience projects. So this would benefit those in the vulnerable segments, protecting their livelihood and sources of income. It also opened up the chance for certain segments of the labor market to retrain and retool in line of the new demand of these new sectors. Besides that, it will also allow Malaysia to explore new and greener technology in its energy generation. And at the ASEAN level, for example, ASEAN also plans to adopt a whole of system approach to build financial sector resilience to climate risk. And an ASEAN Green Map would also be developed to ensure a comprehensive green financial ecosystem that cuts across banking, insurance, and security sectors, ancillary services, for example, green certification, advisory services across regulatory jurisdictions.
Thank you. So we're almost out of time, but Ms. Howard, there's something I wanted to ask about, particularly for the Monetary Authority of Singapore. You recently announced that within the next 2 years, you're going to incorporate climate-related scenarios in the annual stress tests for the financial industry. Can you tell us a bit more about how banks are currently using scenario analysis and how that goes into their business planning scenarios and what you expect to see from financial institutions in this regard in the near future?
Thanks, Jason, for that question. So, as a financial sector regulator, we do expect financial institutions to have a rigorous methodology in scenario planning, stress testing their portfolios. But there are huge challenges in this space, whether in data collection, whether in the methodologies, in understanding transmission mechanisms. So we started 2 years ago in 2018. We included a flood scenario in our industry-wide stress testing for insurers. And that was to, understand the impact of, severe flood scenario in Singapore. What's the impact on insurers' balance sheets? But that clearly, of course, was a first step, a baby step. And over the next 2 years, we hope to work with financial institutions to incorporate a wider range of risks and, extend the stress test not just to insurers, but to other financial institutions as well. And the current state of play, I would say, there's a wide range, and we're in early stages. Practices are quite nascent, but there are bright spots. We've seen more advanced financial institutions test both physical as well as transition risk within their portfolios. So, for example, what is the impact of flood? What is the impact of water shortage, and so on and so forth within the impact on their portfolio. So that's on the physical side. On the transition side, the more advanced financial institutions have also considered things like, what about a raise in carbon pricing, carbon taxes? How would that impact individual borrowers? How would that impact portfolios? And what does that mean for the institution in terms of risk? And what are the steps that they need to mitigate that? But clearly, many institutions are not there yet. And so in the preparation for incorporating a wider range of stress testing, climate stress testing, environmental stress testing scenarios into our industry-wide stress testing over the next 2 years, it's not about perfecting the stress testing come year 2 when we start, but it's about working with academia, with financial institutions, with universities, with experts, with science, to understand what really are the transmission mechanisms. What are the new technologies that we can employ to collect data better, to measure some of these impacts better? And what are the challenges that financial institutions, large to small, face? And how do we then systematically work through some of these challenges so that we can create more robust measurement methods as well as stress testing methods to incorporate a forward-looking element in the way that our financial institutions not just assess their climate risk, but also disclose it in a meaningful way for broader use by the public. So that's the plan, and we are reaching out to many stakeholders, including other regulators, and we hope to be able to collectively achieve much more in this area. Thank you.
Thank you very much. So that's really takes up our time. I just want to do a quick recap of some things that we learned here. Building from climate disasters rebuilding from climate disasters is extremely expensive and costly. So fighting it before it happens is definitely preferable. Climate risks definitely are a threat for simple things such as crops, which is going to impact whether it's a disaster or just reducing crop yields. So that's something that every country needs to think about. Achieving net zero demands some common standards, and it sounds like there is a lot of commonality in thinking, at least across Asia. A new watchdog is probably not the answer. And then there are still opportunities on the demand side, but also especially in non-fossil fuels, new energy opportunities, as well as non-fossil fuel infrastructure. And then lastly, measuring the impact is really important. And the better we do that, the more opportunity we create to allow improvement, but also to help support those aforementioned opportunities in investment. So I want to thank all of our panelists here today for their time. Ms. Noor Shamshia from Bank Nadira, as well as Yusung Lee, Satoshi Akita, and Ms. Hong Shin from the Monetary Authority of Singapore. Now, the next session that's available today is a conversation with Mark Hyman, the United Nations Special Envoy for Climate Action and Finance. So thank you all today for tuning in, and thank you all again to the panelists.